Welcome to Commercial Real Estate Pro Network's CRE PN Radio. Thanks for joining us. My name is Jade Aaron Gross. This is the podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today, my guest is Kyle Tushaus. Kyle is a partner with Pine Ridge Capital. He has a background working for family offices under a sponsorship model focused on acquisition. And in a minute, we're going to speak with Kyle about syndication and the current macro environment and how that influences your micro investment decisions. But first, a quick reminder. If you like our show, CRE PN Radio, there are a couple things you can do to help us out. You can like, share, and subscribe. And as always, we encourage you to leave a comment. We love to hear from our listeners. Also, if you want to see how handsome our guests are, be sure to check out our YouTube channel. You can find us on YouTube at Commercial Real Estate Pro Network. And while you're there, please subscribe. With that, I want to welcome my guest, Kyle. Welcome to CRE PN Radio.
Yeah, thanks for having me. To be here. This is actually the first podcast I've ever done. So this is a interesting experience.
Well, we'll go easy with you then. No, Kyle, I'm glad you're here and looking forward to our conversation. Before we get started, if you could take just a minute and share with the listeners a little bit about your background.
Yeah, my background, even prior to commercial real estate, I actually got started as an engineer in the oil and gas industry, that was interesting and highly technical and exciting, but it's definitely something that's more enjoyable when you're in your early 20s. I'll say I moved around a lot and eventually got to a point where that was either going to send me overseas or I was going to need a change of scenery, so to speak. And I had just gotten married, so I took option B, and I had some opportunities sitting on my plate at the time when I was given that option to try out some commercial real estate deals. They were kind of centered around the energy industry, kind of without going into too many details. A friend of a colleague had bought some properties that they wanted to redevelop, and there's some hidden oil wells on them that he didn't know about. And so I got started by helping him mediate that issue. And that was kind of the impetus for getting into commercial real estate. And within the commercial real estate industry prior to this, I've worked for two family offices across all product types, heavily focused on hospitality, office, and mixed use. Across both of those, that was probably the bulk of the dollar amount that we were focusing on were those three. But like I said, they both were opportunistic. So just about every single product type we got into. I think the only thing I can say I've never really touched is self-storage or mobile home parks. Those are the two asset classes where we kind of steered clear. But following those two, sponsored a few deals on my own. That was in 2020, which was a great time to go out as a GP. Got a few deals done despite everything that was going on in 2020. I was really excited because I thought I would get some screaming deals. But you can keep a pretty good poker face going when you don't have to pay the mortgage and when everyone had their debt paused. I think that was probably the toughest negotiation landscape I've experienced, just because nobody actually had to do anything. So you kept getting 2019 pricing on, zero cash flow in some cases. And in that approach, most of the LP focus was on institutional firms. And so I was kind of mimicking what I was doing at the family offices, where we'd build out the LP tranche with one, maybe three at most capital groups. So I was rinsing and repeating that model because that's what I knew. But it came with a couple of issues, because when you only have, say, one LP, they know they have a lot of leverage against you. And so I got retraded 100% of the time on all those deals. And that led me to the current vehicle that my business partner and I are just now launching, where the approach is taking the sort of institutional approach, the commercial type deal or thesis that we might use for any of those product types, but putting it through a syndication model, which is more akin to what's being offered, say your individual accredited investor. And so we're keeping it below an $8 million or thereabouts deal size, and using a syndication structure to actually put the deals together, with the idea being we're going to offer the institutional type returns and fee structure, which is better than what the syndication landscape is offering investors, and offer it in that portion of the market.
Got it. So wanted to go back here to say you mentioned your experience in the institutional investment world, and kind of a limited number of LPs that you dealt with, and how they treated you differently when you went out and tried to do some of the smaller deals and the retrade. I wonder if you can just expand on that a little bit, because it's funny. I've talked to a number of syndicators, and I don't know that anybody's ever kind of shared the backside, or what goes on behind the curtain kind of thing in those situations. But it was kind of fascinating when I heard you say it. I thought, wow, that's a surprise. One of those lessons you only learn by going through it, I suppose.
Yeah, I think we touched on this a little bit when we were face to face several weeks back, didn't we? When I was kind of talking about the heartburn I went through. Yeah, so on those, and again, I'll caveat this by saying this was during 2020, so it was an interesting time where I feel like people were more keen to burn a bridge maybe than they would have been in normal times, because they thought, to hell with it, like who knows what's going to happen, and maybe I'm just being too nice, I don't know, but and I won't throw out any names because that could come back to bite me. It's a very small industry, despite the the dollar size of the industry that we operate in. But a good example is, one, we had a really clear thesis on what the returns were going to look like. We were going to convert a hotel into apartments, which is now a thesis that I think just about everybody has seen. But one of the last things I did in the family office direction was help launch a fund for that thesis, and said, okay, well, I learned how to implement this. I'm going to go do one on my own, and had found one where there was several characteristics about it that led to, you had to mess it up a lot to not make a good amount of money, because it was by right zoning. The city already had tried to get this to happen in the past, so they rolled out the red carpet for me when I said, this is what I want to do with the property. They said, we're going to fast track the approval on this. The property was 18 separate buildings, so I could actually renovate and convert them piecemeal and not disrupt the operation. So it wasn't even hey, let's take our cash flow down to zero and renovate this as fast as we can. I could still operate the hotel and turn over one building at a time on my way to the conversion. So there were all these things that were stacking up where it's like, despite it being 2020, look at all these ways that we can protect our downside. And that's not even just, speaking of the difference between the price we were paying for the hotel and what the rents were in that market. And they were all extended stay too. So it's not even like I had to convince people to live in a shoebox. They were already 520 square feet or above. So it almost looked like the stars were aligned. And during 2020, my thought was, oh, this is a no-brainer. This is going to be great, and LPs are going to love it. And so we got through DD is the last week, and this happened several times, that this one was particularly, stung particularly bad, because I had lined up all these contingencies. Not closing, but going hard on Friday, they call me on Monday and say, you think you can get a couple extra $100,000 off the purchase price? We would feel better if this was at least $500,000 off. We're already like at a good price. And I said, you guys are just kind of, being mean. Like, we should just do the deal. The returns look great. Why risk it? And they said, well, see if you can make it happen. So pulled some strings, kind of probably pissed off the seller a little bit, got the 500 within 24 hours, went back, said, all right, let's do this deal. Well, you think you could get another 750 off? And so what was actually happening is they just kept coming back with requests that were going to get harder and harder, and were not going to get fulfilled by Friday. So on the second request, I called them out on it. I said, you guys realize that another dollar off on this deal doesn't get it over the fit. Like, that's not the crux of why this should or should not be done. We are far beyond the level of, suitable risk-adjusted returns. And they pretty much just blatantly said, well, here's the thing. You're going to be 10% of this deal as the GP, which is standard. We have your 10%. and we kind of just want to do the deal without having to pay you either any management fees or promote or anything like that. So what we're going to do is either you take our terms or we're going to let you fall out of contract because you only have 3 or 4 days before your money goes hard. And we know that's not long enough to get another LP on board. So it's either going to be this or we'll let you fall out of contract and we have the seller's number now. We'll just circle back with them and we'll buy it. So that was kind of the standard operating procedure just about every single time towards the end of the deal. And when you're in that position, you kind of just, I used to have a kind of a mentor that said, look, at the end of the day, you should drop your ego and he who gets paid wins in this game. And I agree with that. But then also if something keeps occurring like that over and over and over again, you have to go reevaluate your business model. And so that was one of the experiences that kind of highlights the games that were being played maybe in 2020, or maybe that's just luck of the draw maybe for me. But I'll say that it was still a kind of a standard procedure or a standard move, even when I was at those family offices. The retrades when the clock was almost run out was kind of everybody did it just because they knew they could. It's almost like, hey, once I tie up a property, I'm going to ask for money off, because the worst thing the seller's going to do is say no. And then I'll just say, okay, well, I'll still do it anyway, but you might as well ask. So that's what pushed me in this direction.
It's fascinating to hear kind of the inside baseball talk there a little bit about, some of the more of the details and the nuances of the negotiations there. Do you find that to be, or was it a case particular to one or two LPs, or was it more just the time, or do you think it was just kind of the way the big boys were prepared to play?
Yeah, I want to say a lot of it had to do with the time and the market environment. I mean, everybody thought the world was going to end, right? And I was kind of approaching this with, I had just gone out in January of that year saying, all right, I'm going to do my own deals. I had no, I was not in any capital stacks. I was pretty much all cash. So when COVID hit, from an outside perspective looking in, you could either think I was lucky or brilliant because I had the liquidity and I thought this is going to be great. I've got flexibility and I can go out and, pick up, bargains. And that's not what panned out because, like I said, nobody had to pay their debt during that time, so they could kind of dig their heels in and say, nope, you're going to pay me on 2019 numbers no matter what's happening. And I think some of that trickled over to the actual cap stack negotiations where the LP said, look, we don't know, what's going to happen here. And even if you're talking to us about something like multifamily that should be safe, we're, the downside of doing nothing in that time was zero. And so I think they probably thought, like, why not? Like, let's see if this guy will say yes to just an egregious deal because we can. It's certainly a benefit, and potentially if you're sitting in that position trying to get a deal done, maybe a downfall of our industry, but there's no called strikes here, right? So I can look at deals all day, doesn't really matter. I might have opportunity costs, but the human brain being what it is, we don't really gauge opportunity costs correctly. And so the do nothing motivation was pretty high at that time. So I think that was probably the bulk of why that panned out that way. But I will say that, was negotiating with LPs from Midwest to West Coast, a couple on the East Coast. These deals were all, Detroit or westward. So this is not, I didn't look at anything on the East Coast, but I would say that I had a similar experience with LP groups regardless of geography.
Gotcha. And did you end up doing the deal?
Yeah. Once you're in that position, you kind of have to just take it on the chin. And so, ended up doing, basically for every situation where that occurred, I kind of had to just say, well, another thing you have to consider, it's kind of sunk cost mentality, which, I kind of just alluded to, the human brain not gauging opportunity costs correctly. And then I fall victim to sunk cost mentality or the sunk cost fallacy. And when you're the sponsor or you're trying to occupy the GP tranche in a deal, you're paying for the due diligence. So in all these situations, I'm looking at, tens of thousands worth of dollars of due diligence efforts that could either just evaporate or you could just say yes and do the deal. So, 100% of the time you say yes and you do the deal. And like I said, you don't necessarily get bent out of shape when that happens, because he who gets paid wins, or he who gets the deal done wins. You just change your business model, right? And you say, okay, well, stepped in a bear trap over there. I'm still alive. I just won't step there anymore, right? So you go find a different path. So yeah, did every single deal and kind of bit my lip and just moved forward. But yeah, going for future deals, looking to avoid similar situations, and saying, it's a lot safer if you let's say you got 20 people or entities making up your LP investment tranche, and you get one person that pulls that kind of move, and you could just look at the other 19 and say, hey, does everybody want to increase their capital allocation by X% and just replace the person that's saying that? And you have that flexibility. You don't have that flexibility when you've gone to a single shop to fill out your cap stack. So
Yeah, no, he who has the money makes the rules, kind of thing, right?
Yeah.
So
look at Elon Musk just skirting every SEC rule that you or I would be held to. Yep.
Yeah. So you mentioned the Pine Ridge Capital model you guys are working with. You were trying to get returns for your investors similar to what they might expect on the institutional side. Can you kind of give us a comparison as to what you see in the syndication model that you see out in the marketplace, as opposed to what you were experiencing on the institutional side?
Yeah, so prior to this, I could not get anything past the underwriting phase if I didn't feel like we had a shot at getting above a 20% internal rate of return for a reasonable amount of risk. So that was kind of our benchmark, where we had to say, look, if we can't hit 20 at a deal level, there's not going to be enough flexibility for what actually trickles down to the investors after fees and all of that, for it to be worthwhile. And obviously you don't go reaching for yield just to try to get over 20, right? The 20 has to be, with a stabilization plan that makes sense and is, somewhat expected, given the environment. Now, I would say the main difference, and again, I'll say that I don't have a massive amount of experience in the syndication world. It's more of having friends and family and colleagues show me and tell me what kind of things they're getting pitched. On the institutional side, there's always some kind of give and take that a deal might have. So if I have a really high IRR, first thing I'm going to ask, is this predicated on the exit, right? Or am I getting a good cash on cash return and a kind of a light pop on the refinance or the exit price? Like, where am I on that spectrum, and what aspect of the cash flows am I giving up on to get the thing that you're advertising to me? And it was very sort of cut and dry on that, right? We said, like, we have to do X, Y, and Z. Like, let's say it was a hotel renovation, and we knew that this property was trailing market rates, and here was the growth year over year, and it was in a market that was desirable and, not subject to high seasonality, whatever the case might be. We'd say, okay, we're going to spend X amount of dollars to renovate it. It's now going to place it at this point in the market. And then if we can run it at this margin, right, this is how it's going to flow through. It was very, cut and dry. And you would say in that situation, well, what's my biggest risk factor? How are you going to control the renovation? And so we had a particular firm that I'm actually, speaking to. We might have said, well, we bought a GC firm, so now we control construction costs. So there, okay, you've solved for the biggest risk factor. So great, now I see what's going on. But you couldn't really, if I said, look, it's going to be 6% cash on cash return until we can actually start popping the rates. And then after we pop the rates, right, it's going to take some time to work through the market. And then we got to actually have things trickle down to the net operating income line. So this is what the timeline is going to look like. And then I compare that to the experience in, say, the syndication world, where I'm seeing deals that, say, like in the hospitality example, come with an operating business, but then it's an operating business that none of the sponsors have experience with. And this very much might be people just reaching for yield, which is a very natural human behavior, especially when we're at this point in a business cycle. But I see sponsors say, we're going to take on a business model that we've never done before, and that's how we're going to get you to X% cash on cash returns. And I question these models where it's like, I think I would take a lower cash on cash return, or maybe not such high octane returns, in an investment where I'm not banking on you figuring out this business model for the first time. And then beyond that, you might be buying 5 properties that require this business model. And, I'm speaking to some things that I've seen in the market. And a lot of these returns are kind of predicated upon you trusting that they're going to just figure it out. And of course, I'm the man with the hammer, so I'm looking at this through the lens of if I was on the other side of the table pitching a $500+ million AUM institutional firm, they would laugh me out of the room. And so, now when I talk to friends and family, if somebody says, "Hey, I invested in crypto," is the big one recently, right? They say I invested in some kind of crypto fund. I always ask now, how often have they been distributing cash on that thing? Because I hear people talking about, double-digit cash on cash returns, and then, oh, when we sell this thing, it's going to be even more. And then I just say, when was the last check? And of course, this is not a scientific approach, but it kind of seems like the marketing, my marketing beforehand, I had to sort of downplay the returns and over deliver. It almost seems like the tables are flipped in the syndication realm, at least what I've been exposed to, where it's like, you got to promise a lot and get people's eyeballs on it. And then afterwards, like, if you don't distribute, tell them why you didn't, like supply issues or something like that, which, from my standpoint, I'd be like, all right, I'm not investing in you again if you tell me that kind of stuff. But I might be too jaded from where I'm coming from. But that kind of seems like the difference where, pitching institutional money, I would just have to handicap the deal so much and then say, we're still at 16% IRR, right? And I have just thrown everything I can at this thing. Like, short of, a meteor hitting this building, right? We're not going to lose money. Where that doesn't seem to kind of be the bar that I have to get over if I were to put together a syndication thing. And I'm sure there's some syndicators out there that are listening to this saying, screw you, like, we're very diligent, but there's always outliers. And I'm saying that's kind of what was pitched to me initially, and why I said, well, why don't we just take institutional model, pull it down market where I'm not competing with institutional capital, give them the same structure, right? We'll syndicate it, but right, these crazy promotes where you got sponsors taking 50% of the cash flow, like, I would never be able to get that to pan out at the institutional level, so I'm not going to pitch that to any investor. So we'll stick to reasonable rates of fees and promotes, and then look for deals where, like I said earlier, heads I win, tails we don't lose.
No, that's enlightening to hear kind of the how you were required to act on the institutional side versus kind of maybe what the less sophisticated or experienced syndicator may be promoting. So talk a little bit about the Pine Ridge Capital. What is your model, your thesis? What are you guys looking to do and go after?
So outside of just saying lower deal size, trying to eliminate competition in that regard, and we, like I said earlier, there's enough tech tools nowadays to where you can manage a pretty disparate portfolio of smaller assets without getting bogged down. Now, if I threw something like a hotel in there, obviously something like that, if you're in the portfolio building world, you hand that management off to somebody else. But for the most part, right, trying to asset manage that much, you don't need, if you told me buy one $50 million asset versus 10 $5 million assets, yeah, those are more moving pieces. But I can systematize a lot of things, and I can solve for a lot of the friction in the terms of the management and keeping up with the paperwork. That doesn't necessarily mean I need to charge a crazy management fee to do that. But then outside of saying we're going to bring it down to a lower price point in the market to try to get rid of some of that larger competition, we don't really have a product type that we're focusing on, right? We're agnostic, and we're really just looking for the right opportunities in the right submarkets at the right price with the right stabilization thesis. I will say we're only looking at the Pacific Northwest because that's where my business partner and I live. And so I don't need any more Southwest rewards points at this juncture. The previous deals that I was doing, despite living in the Pacific Northwest, were none of them were in the Pacific Northwest, and so I was flying around a lot. These will, our focus will be hyper local. We got to be able to drive to them same day if need be. But then the way we enter any of these is looking for opportunities where we'll have a thesis. Usually we try to find one or two, maybe three avenues just beyond the base thesis that we could go after. So things like, I think most people are probably familiar with a covered land play. So, one we're kicking the tires on right now. It's got a building on site where I could quickly lease it out to somebody for say 3 years, get my ducks in a row on a go vertical plan for multifamily while we're getting cash flow. But the idea being, let's ink that lease for 3 years with a clause that says, hey, we're going to develop this thing and we'll go find you another property. So you get the tenant working hand in hand with you. And for the effort, right, they get a slightly below market rental rate, but that rate still covers your debt service and everything you need to do with the property, maybe distribute a little bit at the same time. But during those 3 years, right, we're actively putting together a vertical multifamily development. And then when you're ready, right, you go place that tenant in another property. So you actually turn the first deal into two deals because you might actually go acquire the property that they're going to go be placed into. And then you can scrape the original building and go vertical there. So that's a good example of one where we say, okay, day one, let's say we just get in day one, we don't do anything, right? Well, that lease was still cash flowing positively for us, right? And that development potential isn't going away. In this particular case, I'm talking about a submarket that has land use restrictions where it's making it a very, very tight market. So it's very hard to find any dirt that you can build on. And it's also in a market where we have contacts and colleagues existing that can do the construction. But even if we don't decide to go that route, right, let's say we just lock it up, we could turn around, maybe contribute that as 10, 15, 20%, whatever the numbers come out to be, as contribution into a go vertical plan. And we let a developer, some other group, actually do that part and move on to the next one. Or you could do it yourself. So it's an approach where you say, look, day one, we're covered. And then we've got, say, 3 different avenues we could go. And the macro environment, or particularly the market level details, given that submarket, are screaming at us that, it might make sense to go vertical in this case today, but it's certainly going to make sense 3 years from now, 5 years from now. And if you're locked in with something that's going to cash flow right now, you can kind of pick which date you want. Obviously, tomorrow would be the best date if you're going to look at it from an IRR perspective and the time value of money. But if you got to year 2 or 3 and prices are still soaring, you might say, we're going to wait for 4 or 5. And it really doesn't change your returns all that much to have to, wait for that. But you haven't yet pulled on construction financing, right? You're not now making payments. You have that optionality of when you want to move forward. So that's kind of, I'd say that's a good example of how we're looking at the deals we're going into.
Gotcha. And I think you might have said it, but will you be doing syndication like one building at a time, or will you be doing more of a fund approach?
So for the time being, we're going property by property. And that is, primarily in phase one, we're kind of testing out this thesis. I might be able to pull up a notepad and say, why doing, a light industrial play at 4 million makes just as much sense at 40 million. But we want to actually go through the machinations of doing that first. And then phase two would be, let's say you put your head down and you get this, you start chipping away at these and you've got a portfolio of 10 or 12. We'd first go back and probably do a blanket debt refinance over the whole thing, because obviously you get better. That in and of itself is kind of a strategy for return of capital, is get a blanket term across, say, a dozen different portfolios, and at each property level, right, you get better debt terms for that reduced risk as far as the lender's concerned. And I think at that juncture, we would probably look at more of a fund approach. How we would incorporate that into still the syndication market, we're not quite sure. Like I said, right now we're just testing out the property by property thesis. But the holy grail of this would almost be to say kind of be like a CrowdStreet or a Fundrise, where, I guess in Fundrise's case, you don't really get to pick the properties. CrowdStreet, you do, maybe somewhere between that, except we don't want to necessarily be an online platform. I think it would be preferable to operate more like an old school Buffett partnership, where it's kind of like, look, you can chuck your money into this bucket and we're doing X, Y, and Z with it, but scaling up to a billion assets under management is not necessarily the play here. It's like taking this laser focused, like picking off the things that make sense and have this optionality, but in a manner that, obviously you'd want to scale it up to a point where you can move faster than say the one property at a time, but not scale it up so much that you dilute the core approach and the core thesis. So yeah, I guess sort of like somewhere between a CrowdStreet and a Fundrise, but obviously on a much smaller scale, and not marketing on sort of like just submit your information here and then wire is 25, okay, not exactly that model either.
Gotcha. Do you have a minimum investment requirement?
Yeah. So right now we're at $25,000, and we arrived at that one because 25 is kind of a typical minimum. Anything below that, you're kind of just doing a lot, too much movement for not enough contribution into a deal. But primarily because the size of the deals we're looking at, it's pretty easy. You just take, hey, if I want to do a $5 million deal and I have this minimum, divide the deal by that minimum. And if it gets to be too high of a number of investors to juggle, then you might want to increase your minimum. And so 25 is a comfortable number where we feel at that number we'll not have to be juggling the 99 investor limit that we'll have for that type of deal structure.
Got it. Well, it sounds exciting. I mean, the opportunities and the fact that you've got a model for the funding and then the distribution and raising capital and kind of your thesis. Like I said, you're agnostic, but experience with the hotel conversion and kind of multiple exit points. I guess that's kind of what I heard you. I mean, that sounds to me like a more of a safety kind of a thing, as opposed to the one that you got to hit. And if not everything happens like it's supposed to, then what do you do now?
I mean, another thing that I feel like is kind of it's probably not completely lacking, but I haven't heard too many people pitch me on it so far in the syndication world, is this idea of sending it up the ladder in terms of investor risk appetite. And I think the closest thing that I've seen getting pitched on this is, hey, let's call it 100 units of multifamily for easy numbers, and we're only going to renovate 80 of them and leave 20. So the next guy sees that there's meat on the bone. This meat on the bone concept. I mean, I get that, and that was something that entered the conversations in my experience previously. But I always thought of it more as like where certain capital resides in the life cycle or the type of cash flow an investment might throw off. And you could say the same thing, not just about commercial real estate, but just about any, private investment. But, we did a couple of, I was involved in a couple where certain investors like the more risky, like go renovate it, get a bridge loan, right, 2 years and pop the rates kind of thing, especially in the hotel world, right? You go do a PIP or what's called a property improvement plan. And you can now say, they were doing $99 a night. Now we're going to do $160 a night. And once you get to that point, the investors that came along with you for that renovation period and that 99 to, whatever your market rates were, they don't necessarily want to keep that capital in something that's now shelved and you're just sending out your distributions. They want to take that out and go find the next hotel or the next, property, whatever the thesis is that's going to get renovated and marked to market. And so rather than worry about who's going to pay me 100 bips less on my cap rate to sell this thing outright, we were thinking more in terms of how do we recap this project? So in that scenario, right, we renovate the property, rates are going up, property value was, for easy numbers, let's call it a $10 million property. It's now $15 million. We've created $5 million worth of value. but it's still cash flowing at, I don't know, X% that is still attractive to a passive investor. So you'd say, great, our investors that only want that renovation phase, you're out. We're going to bring in new dollars at this new valuation. The new dollars don't feel like they're getting the short end of the stick because we've already renovated and we already took the risk. And we can tell them, look, you're going to get X% distribution on a stabilized asset. And they would say, great, that's what we're looking for. We don't want to trust that you can swing hammers and not screw it up. And so it was never really, I mean, obviously, if you can get somebody, you can buy something at like a 7, do a little bit of work and sell it at a 5. Everyone wants to do that all day. But we always talked about more in terms of recapping, and it was less about, what's the new valuation, but what does the capital that's in the deal actually want out of the deal? And so there was always this, preferred route of saying, like, well, let's not go open market and pay 6% to the broker to go list it and all this. Let's call the groups we already know that want stabilized cash flow on this particular asset type and just pull that tranche out that was the opportunistic tranche and replace it with, right, the new stable cash flow investors. So that's, I don't know, that's something where obviously we're talking, pretty early on out of the gate for this platform that we're doing. But that's another avenue where, if we can get sort of the more like cookie cutter bread and butter type investors that say, don't give me massive valuation increases. If you can tell me I'm going to make 6 to 10% a year on my money and it's going to be stable, fine. I'm okay with that. I don't need a massive exit in a 20+% IRR pop. So that's another angle where I feel like it probably definitely exists. But from my understanding, it's probably less focused on than say the institutional world, where there's always an option of just recapping your project with a different investor type.
Got it. Hey, Kyle, if we could, I'd like to shift gears here for a second. By day, I'm an insurance broker, and I work with my clients to try and assess risk and determine what to do with the risk. And there's a couple different strategies we typically employ. We first look to see if there's a way we can avoid the risk. When that's not an option, we look to see if there's a way we can minimize the risk. And if we cannot avoid nor minimize the risk, then we look to see if there's a way we can transfer the risk. And that's what an insurance policy is. It's a risk transfer vehicle. And as such, I like to ask my guests if they can look at their own situation. Could be clients, it could be investors, could be the market, could be politics, interest rates, however you would like to frame the question as to what you consider to be the biggest risk. And again, for clarification, while I am an insurance broker, I'm not necessarily looking for an insurance related answer. And so if you're willing, I'd like to ask you, Kyle Tushaus, what is the biggest risk?
Yeah, I think right now everybody's kind of afraid of inflation, which is an interesting business environment to be in for real estate, because everybody kind of gravitates towards this industry as a safe haven. I think you can kind of take that a step further and think, if I'm going to de-risk myself from inflation, and I'll say inflation, I don't think is actually the risk I'm getting at. It's eventually, I think there's a risk that I think a lot of people are not thinking about. Some are, but I haven't seen any media headlines about it. But within real estate, right, you might say, okay, well, what's my best inflation hedge within an inflation hedge, right? And that would be a property that I can mark to market more often, right? So the reason why consumer durables doesn't do well in inflation is because I can wait 10 years to buy my next car or washing machine. But bread and butter, I'm going to buy that more often. And so that price can keep going up every time I transact. So how can I mimic that in real estate? Well, the properties that get marked to market more often would be better in an inflation environment. So hotels get marked to market every single morning. So it should be the best inflation hedge, but you've got the dual side of that sword that says it's also discretionary spending. So be very careful on that front. But then, so maybe I'm okay with every year, say in multifamily, the triple net 25-year lease would probably be the worst, depending on how that lease got written. So there's obviously a spectrum even within the inflation hedge that is our industry of commercial real estate. But the thing I haven't heard enough people talking about, and the thing that scares me the most and influences a lot of how we're going into this first phase of deals, is that the labor risk that is kind of bubbling under the surface, where you see a lot of these value add deals. I mean, people have been, ever since 2008, value add has been kind of like everybody and their cousin is getting into this idea of renovating a property and popping the value of it. But I think there's going to be a massive moving target into how well you can control those costs. And so, for like an interesting data point, since about the early 70s, compensation has gone up 115% since the early 70s, which sounds great. 115% increase in compensation, and that's for non-supervising roles. So the roles, the jobs that are actually doing the thing, while productivity of those same jobs has gone up almost 250% during that same time. So there's this massive difference in the throughput that's being provided by somebody in a job versus what they're getting out of it. And I look at the landscape of people now, for the first time in 4 years, even know what inflation is. Our socioeconomic landscape is not great. There's a lot of political strife, and I feel like that gap is probably going to get closed to some degree. And so I see a big risk factor in those business models that are going to be very reliant upon labor as an input, because I think we're about to see a compression of that gap. And I think rightfully so. I mean, you look at some of the numbers, and it's just, I might be a little jaded. I came out of school after the '08 collapse, and so I don't really have I don't have that much of an experience through that run up. But you look at what was accomplishable with, say, your base degree or even no degree 30, 40 years ago versus now, and how much someone's having to work to get the same throughput in terms of quality of life. I don't see it continuing status quo for much longer. Maybe we kick the can a little bit longer, but I don't see people being willing to do it. And the Great Resignation might be sort of the first little cue of it. But yeah, I think what's about to follow inflation is, we talk about energy prices going up, housing prices going up. When labor prices keep going up, and right now it's the remote workers that are driving the leverage in those negotiations, it'll eventually get to all labor. And if your investment thesis is heavily dependent upon labor, I would think of some ways to lock that in. Ways that we mitigate that, right? If I see a value add deal, it's got to be in a market where I've already got a pretty good relationship with the GC, and I can go to them and say, do you want to be part of the GP tranche? And so with that, I can say, you're now going to have equity incentive, not just hourly rate or markup incentive. So let's put together a budget of a do not to exceed, and you control that cost, but you're also in our cap stack now. Outside of that, I would be very worried about taking that GC risk, because I hear horror stories of colleagues having guys walk off the job for $2 more an hour. And it kind of sucks when you've already pulled the debt on the deal, and you've got this bridge loan kind of clock ticking away at you. But then you look at the data and you're kind of like, well, I don't necessarily disagree with it. I mean, if someone offered me more, you'd probably do the same thing. And so I think it's something that needs to be taken into consideration when you're underwriting, because I do think that's the next big wave to follow in this inflation run up.
No, that's enlightening there. Just the wage growth and how it's likely to affect a lot of things. So I got it. Kyle, where can listeners go if they'd like to learn more or connect with you?
So they can either submit something through the website, which is pineridgecap.com. That's PINERIDGECAP. So it's cap instead of capital for the website. Or you could email me directly. It's just Kyle, KYLE, at pineridgecap.com. That's probably the quickest way. That's direct to the horse's mouth, so to speak. Yeah, and we're not on any social, unfortunately, so I can't tell you to follow our. I'm not even on social personally, so I'm kind of behind the times in that regard.
Gotcha. Well, Kyle, I can't say thanks enough for taking the time to talk today. I've learned a lot, enjoyed it, and look forward to doing it again soon.
All right, likewise. Yeah, we'll definitely I'll keep you in the loop on everything we're seeing.
All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.